Please take a moment to pause this video and read in full this important disclaimer. This demonstration is for educational purposes. Decisions to buy, sell, hold, or trade securities, commodities, or other investments involve risk and are best made based on the advice of qualified financial professionals. Under no circumstances shall we be liable for any loss or damages you or anyone else incurs as a result of any trading or investment activity you or anyone else engages in based on any information or material you receive through barchart.com or our services. During the opening hours of our markets, retail and institutional traders alike are reacting to the previous day's news or current market information. And they enter orders in response to this new information. The inflow of these orders unbalances our markets and it pushes prices up or down. As a result of this activity, it often creates that day's high or low. And this simple concept of order flow and time of day creating trading opportunities in all of our futures and Forex markets is a powerful probability. And what I hope to convince you of is that this probability of these highs and lows being established during the marketing openings of around the world will help you pick better entries and more profitable exits. Okay. So this is the premise. Openings create price movements. Price movements come with volume. And volume confirms price. Okay, so there's my ruler that I drew. And yeah, there's a lot of red lines on this one. I know, I apologize. But again, what I want to really kind of emphasize to you folks is that here's a market that is traded around the world, just like oil, an industrial metal. And so it's going to be influenced by a U.S. market. It's going to be influenced by a European market. It's going to be influenced by Asian markets. So here we see a spike in volume above our volume average, 3 a.m. 3 a.m. Chicago time, 9 a.m. London time. Right? And we made a high. And then price reversed during the US session. The intraday trend is now down. How far could copper fall based on the high that was created in the European session to the low that is going to be a higher probability in the US session? Well, there it is. There's our high. There's our low. There's that potential demand zone that I could have bought into. This zone was created during the end of the European session and the beginning of the US session. Volume confirms price. All right, let's look at today. Again, a high that was created during the European session, right? Not a big spike, but just enough to alert us that there's something significant here. Price returns that zone during the US session, fails, and then trends lower. How far did it trend lower? 1 ATR. If I was looking for a buying opportunity, I'd be a lot more patient. I wouldn't be looking at this zone anymore because this zone was already used up over here. I want to look for something fresh. And there it is. Right there. Is this going to be a good zone for me to take? Well, let's see. It was created between 7 and 10 o'clock in the morning. It had a spike in volume. Did the market shoot away from that area? Yeah, it did. So regardless if I was taking a short or a long, I have to respect this zone. If I was short copper, I want to look to make sure I take profits before the market gets to the zone. If I'm looking for a buying opportunity as copper is falling, instead of trying to catch a falling knife, I'm going to wait patiently for my zone that I can confirm with price and time of day. And then also my measuring stick I hope this video was informative. If you enjoyed today's content, make sure you subscribe to Bar Chart's YouTube channel and give the video a thumbs up. Until next time, the good of all trading.